Welcome to The Explainer. Today we're diving into a heist that is just absolutely massive. And the crazy part? No ski masks, no cracked safes, no getaway cars. The only getaway vehicle they used was a spreadsheet. We are talking about the Philippine ghost receipt scandal.
50 billion Philippine pesos. Let that sink in for a second. That is the staggering size of this unpaid tax theft. But you know what's even more unbelievable than the sheer scale of that number? The timeline. According to the National Bureau of Investigation, this operation ran completely undetected from 2008 all the way until December 2022. Think about that. 14 years of a completely fabricated phantom economy just bleeding public revenue.
So that brings us to the big question. How do you fake 50 billion pesos using only paper? Seriously, how do you create the illusion of genuine trade, real invoices, tax IDs, corporate filings, without actually supplying a single good, service, or employee? Well, the secret was turning false transactions into an industrialized service.
Part 1. The 50 billion peso heist. 14 years of phantom operations.
Okay, let's get right into it. To really wrap our heads around this, we have to stop thinking about it as a simple accounting error, or, a single rogue employee messing up a ledger. This was a highly organized commercial infrastructure. Investigators estimate that around 1,000 companies tapped into this central network. Over those 14 years, these businesses allegedly bought fabricated invoices and receipts, and then used those totally fake documents to slash their VAT obligations and inflate their deductible expenses. It was literally a massive illusion hiding in plain sight, simulating millions in commercial activity from a single common location.
Part 2. Anatomy of a ghost and how they manipulated the VAT system.
To understand this crime, we first have to understand the weapon they used. Enter the ghost receipt. By definition, it's a fabricated invoice that creates input VAT and false economic events without an authentic supply of goods or services. The absolutely crucial takeaway here is that you can't just look at this as an accounting quirk. A ghost receipt literally creates a false economic reality. It hides the movement of funds and makes totally unlawful tax benefits look like ordinary corporate savings.
Here's exactly how it works step by step. Now, normally, a legit company charges output VAT to its customers, deducts the input VAT they paid on real business purchases, and pays the difference to the government, right? But in this scheme, Step 1, the buyer just purchases a fictitious invoice. Step 2, they record that fake purchase and claim the associated input VAT credit. And boom, Step 3, they drastically reduce their tax liability. Oh, and as a bonus, that same fake invoice inflates their business expenses, lowering their reported taxable income. So they were effectively cheating corporate income tax and VAT at the exact same time. There's this one quote from the investigation that hits the nail on the head. It goes, "The weakness lies not necessarily in the form of the document, but in the absence of the economic activity it claims to represent." And that right there is exactly why this fraud worked so well for so long. The receipts look completely legit. They had a registered supplier name, a taxpayer ID, a total value, a VAT amount, an authorized signature, the whole shebang. It was false evidence, perfectly designed to sail right through an audit.
Moving on to Part 3. Industrializing the corporate illusion. The fraudulent service network.
So how exactly do you scale a scam like this? You industrialize it. When dozens of companies are buying from the same fake invoice provider, it morphs into a massive fraudulent service network. The syndicate basically manufactures these deductible expenses for their clients and charges a commission for the paperwork. Look at the contrast here. On the left, a legitimate network has physical offices, actual employees, and real inventory. But on the right, this ghost network was linked to over 100 registered corporations that were entirely empty. They had incorporation papers and bank accounts, sure, but absolutely zero operational footprint. No employees, no warehouses, no nothing. Just shared computers and the exact same accountants pulling the strings behind a curtain.
And they were so strategic about it, it's kind of mind-blowing. To make these fake expenses look commercially credible to an auditor, the syndicate actually matched the invoices to the specific buyer's industry. Like, if the buyer was a construction firm, the ghost invoice would magically come from a fake entity specializing in building materials. If the buyer was in hospitality, the fake invoice was suddenly for food products or logistics. They even rotated these dormant shell companies the second one of them came under investigation. It's just a wildly audacious level of camouflage.
Part 4. Following the phantom money and the intersection of tax fraud and money laundering.
Now we get to the crackdown. When tax evasion involves hiding proceeds through shell companies, you've officially crossed into money laundering territory.
Investigators had to follow this phantom money by hunting for some very specific red flags. For example, buyers would transfer the full invoice value to the ghost supplier just to make the bank records look real. Then, the fake supplier keeps their commission and secretly returns the rest of the money right back to the buyer. Investigators were also flagging supplier accounts acting as simple pass-throughs, massive payments going to totally inactive vendors, and just super rapid fund redistribution, because when financial behavior radically conflicts with the supposed commercial relationship, that's when the whole illusion starts to crumble.
To prove this was all one unified operation, investigators had to lean heavily on digital forensics. They raided locations and seized shared computers, templates, and accounting files. Because these ghost corporations had no physical operations, their centralized control left a massive digital fingerprint. Things like discovering multiple supposed competitors sharing the exact same email accounts, the same IP addresses, and the same accountants. That network analysis of their digital infrastructure was the absolute key to exposing the whole operation.
And just look at the impact of exposing that infrastructure. This 50 billion peso case became a massive catalyst for enforcement. The Bureau of Internal Revenue set up their Run After Fake Transactions program. In 2023, collections from this program were around 600 million pesos. Fast forward to 2025, and that number skyrocketed to over 4.3 billion pesos in collections, targeting both the sellers and the buyers of these ghost receipts across all sorts of sectors.
Part 5. Building a resilient defense and securing the corporate vault.
So, for the corporate leaders and FinCrime teams tuning in, how do you stop this from infiltrating your own ecosystem? How do you defend against the threat that looks exactly like a normal piece of paper? You have to build what we call a resilient control stack. Conventional document checks often miss these ghost transactions because standard onboarding usually just confirms a company legally exists on paper, not that it actually does business. You've got to dig deeper. You need real supplier due diligence to verify actual operational capacity. You need transaction validation, meaning match those purchase orders with actual evidence of delivery, not just the invoice. Use network analytics to hunt for shared addresses or devices. Throw in risk-based accounts payable monitoring, ensure professional accountability in your tax teams, and share intelligence. You have to test the real-world business activity beneath the document.
Looking ahead, there is a major defensive opportunity on the horizon. The Philippines is rolling out expanded electronic invoicing with a mandate deadline of December 31, 2026 for covered taxpayers. Structured e-invoices are great because they allow tax authorities to cross-check supplier and buyer records incredibly fast, easily flagging duplicate numbers or inactive taxpayers. But a word of caution here, digitalization is not a magic bullet. Criminals can just as easily create false digital transactions. E-invoicing only works if it's combined with rigorous identity assurance and proof of actual physical delivery.
Which leaves us with one final critical question to chew on as we wrap up this explainer. I want you to look at your own supply chains, your vendors, your approved accounts. Are you absolutely certain the companies you do business with actually exist in the real world? Because as this 50 billion peso phantom heist just showed us, sometimes a perfectly formatted piece of paper is really just a very expensive ghost. Thanks so much for joining me, and always keep questioning the reality behind the receipts.